We will now continue our third discussion on analyzing transactions into debit and credit parts using T accounts. The goal of this session will be to discuss how transactions affect owner's equity accounts using T accounts. Thus far, in Chapter 2, we have looked at T accounts and debits and credits. We've also looked at what the normal balance side is of each different type of account and how a variety of different transactions can be analyzed using T accounts into their debit and credit parts. In this next section, we're going to take it one step further. We're going to utilize T accounts to help us analyze how transactions affect owner's equity. So let's look at our first transaction. On August 12th, received cash from sales $295. In Chapter 1, we go back to thinking about the variety of different accounts that we explored. And when we looked at the sales account in Chapter 1, we realized that the sales account impacted the owner's equity section of the accounting equation. If you recall, we said sales and/or revenues, expenses, capital, and withdrawals all related to the owner's equity section of the accounting equation. Well, when we're tracking our different types of transactions, we also recognized in Chapter 1 that it didn't really make a lot of sense to lump all of our sales right into the owner's equity section. That's why we broke it out into a separate section called sales. We created a special account just to recognize the sales associated with our business. We also created a special account called expenses to recognize the expenses associated with our business. And then lastly, we also recognized what we called the withdrawals account to recognize when the owner takes cash or other assets out of the business for his own personal use. In this transaction, we can see when we say received cash from sales $295, if we go back to our 4 basic accounting questions for analyzing transactions, our first question asks which accounts are affected. If we look at it, we see that our accounts are cash and sales. Our second question, how is each account classified? Well, cash is an asset and sales are an owner's equity account. How is each classification changed? Well, we discussed this back in Chapter 1 as well. Whenever we hear the words received cash, we know that there's a positive impact on our cash account, meaning our cash account is going up. And the same thing, when we sell something, that's a positive impact upon our owner's equity, or a positive impact on the business for the company. So we say that the sales is going to go up. So, in this particular transaction, if we look at and we analyze this transaction, we now know that we're going to debit our cash and we're going to credit our sales account for the $295. Let's look at another transaction affecting the owner's equity account, one we also saw back in Chapter 1. Sold services on account to Oakdale School, $350. Again, we ask ourselves the 4 questions. Which accounts are affected? First, we say accounts receivable, Oakdale School, and second, sales. How is each account classified? Well, accounts receivable is an asset, meaning we're going to be receiving at some point in the future money from Oakdale School in the form of cash. And we know that we have a sales account, and that sales account is going to be classified under owner's equity. How has each classification changed is our third question. In this case, since our sales are going up, meaning we've sold something, we're going to have a positive impact on our sales. And in addition, since our accounts receivable is increasing, we're going to have a positive impact on our accounts receivable. Therefore, we're going to debit our accounts receivable and we're going to credit our sales. Let's look at another type of transaction. Paid cash for rent, $300. Again, we ask ourselves the four questions. Which accounts are affected? Well, we see the word cash, so we know cash is going to be reflected, and we see rent. So when we look at this transaction, because we hear the words paid cash right off the bat, we know if we're paying out cash, then our cash account is going to go down. And if we're expensing something called rent, that's going to have a negative impact on our owner's equity account. If you recall, back in Chapter 1, when we did the transaction paid cash for rent, we had a minus under the cash column and we had a minus under the owner's equity column. Well, in T accounts, we have to really look at this transaction a little bit more closely. Because if you recall, we said that rent expense impacted the owner's equity account. But in essence, it has a negative impact on the owner's equity account. So this makes rent expense a little unique. If you think about it, whenever we see a rent expense, it's going to have a negative impact on our owner's equity account. So therefore, whenever we have any type of expense, it's going to show up as a debit to that expense because it's under the debit side or the minus the decrease side for an owner's equity account. So the normal balance side for any expense is going to be a debit because a debit has a negative impact on the owner's equity. So when we look at analyzing this transaction, we say which accounts are affected? Cash and rent expense. How is each account classified? Cash is an asset. Rent expense is an owner's equity. How is each classification changed? Cash is decreasing. Owner's equity is decreasing, but the expense is increasing. So if you remember, going back to our rules for debits and credits, an account increases on its normal balance side. So with respect to an expense, when it's increasing on its normal balance side, which is a debit, it has a negative impact to the owner's equity. So therefore, it's reflected on the debit side of that account's T account. So how is each account classified? Asset, owner's equity, rent expense. How is each amount entered in the accounts? We're going to debit our rent expense and credit our cash. Now let's look at how an account is affected, or two accounts are affected, when we receive cash on account. When we hear the transaction, received cash on account from Oakdale Schools, $200. The first thing that we have to note here is that this transaction does not now affect the owner's equity. This account, or the sales transaction affected the owner's equity when the actual sale took place. So in this case, we have to look at, again, answering those four accounting analyzing transaction questions. Which accounts are affected? And in this case, received cash on account from Oakdale. We know that we have the cash account and we have accounts receivable Oakdale School. How is each account classified? Well, in this case, we have two assets. We have the asset cash, and we have the asset accounts receivable. How has each classification changed? Well, in this case, our cash is going up, it's increasing, and our accounts receivable is going down, it's decreasing. How is each amount entered in the T accounts? Well, in this case, because our cash is increasing and accounts increase on their normal balance side, we can say we're going to debit our cash. And since accounts receivable are decreasing and accounts decrease on the opposite side of their normal balance, we can say that we know that accounts receivable will decrease. So we're going to credit our accounts receivable. Now let's look at how the owner's equity accounts are impacted when the owner withdraws cash for personal use. We have the transaction paid cash to the owner for personal use, $125. As we learned in Chapter 1, we're going to analyze our transactions, and when we ask ourselves the first question, which accounts are affected, we know that our cash is being affected, and we know that the owner's equity section is being affected. And we called this, back in Chapter 1, owner's drawing, or a withdrawal. Okay, so in this particular case, when we ask the question, which accounts are affected, we're going to say cash and Kim Parker drawing. How is each account classified? Well, cash is an asset, and Kim Park drawing is going to be an owner's equity. Just like back in Chapter 1, when we saw our expenses had a negative impact on our owner's equity, a withdrawal also has a negative impact on our owner's equity. The primary distinction between the two, though, is that an expense is a normal part of the operations of the business, whereas a withdrawal is not. A withdrawal is not something that takes place in the ordinary course of business, so therefore it's specifically allocated or accounted for on its own. So when we look at Kim Park drawing, we know that it's going to have a negative impact on our owner's equity. It's going to decrease our owner's equity anytime we take money out of the company for our personal use. So therefore, when we look at how each classification has changed, we know that the cash is decreasing, and we know that owner's equity is decreasing. So as Kim Parker's drawing increases, it has a negative impact on the owner's equity, causing the owner's equity to decrease. So therefore we say Kim Park drawing has a normal balance side of a debit. And when we look at how this transaction is analyzed using the T accounts, we're going to say that we're going to debit Kim Park drawing for $125, and we're going to credit cash for $125. This is the end of section 2.3, analyzing how transactions affect owner's equity accounts. This also brings us to the end of chapter 2. In this chapter,